Hey everyone, and welcome back to the Deep Dive. Go ahead and grab your coffee, maybe pull up a chair, get comfortable. Because if you've been watching the screens at all today, that's Thursday, January 29th, 2026, we have a massive amount to talk about. Honestly, the markets are just screaming today.
Screaming might actually be an understatement. I mean, we are looking at a genuinely historic day. This is one of those days you'll probably remember 5 years from now.
Absolutely. I mean, usually we try to ease into these things, do a little warm up, but we have to go straight to the elephant in the room. I opened my trading app this morning expecting, I don't know, a normal Thursday, and it was just a sea of red. Microsoft is down nearly 12%.
12%.
Tesla's down almost 3. Nvidia's taking a hit. It looks like the whole tech sector is absolutely melting down.
It is a bloodbath for equities, no question.
Yeah.
The NASDAQ is really taking it on the chin. But if you're only looking at tech stocks, you are missing the real story. Because if you glanced over at the precious metals charts,
Oh, it's explosive. It is basically a vertical line straight up. We are seeing gold shatter the $5,500 barrier and silver. Silver is trading above $110 an ounce right now. I mean, I remember when we were all excited about it hitting 30, it feels like we're living in a simulation.
it feels like a different era because in a lot of ways, the market structure has fundamentally shifted. And that's exactly what we're here to unpack. We have a huge stack of sources today, live trading data, the latest reports from the Fed meeting that just wrapped up, and some geopolitical analysis from Morgan Stanley, Saxo Bank, and the World Gold Council. Our mission is to figure out why exactly the metals are acting like a rocket ship while the stock market just stumbles.
It really feels like a perfect storm. So let's get into the numbers first, just to kind of set the stage. Gold hit a fresh record high of over 5,600 at one point today. It's pulled back a little. Now it's around the 5,250 range.
Right. And to put that in perspective for you, we aren't just seeing a gradual climb here. This is what we call parabolic movement. The chart isn't moving diagonally, it's moving vertically. We are in what the analysts at Incrementum are calling terra incognita uncharted territory. The old maps of how the market is supposed to work, you can pretty much throw them out. They're being rewritten in real time.
And silver isn't just tagging along this time. I mean, it feels like it's leading the charge in some ways, trading around 111, 112 bucks an ounce. I was reading one of the reports that said silver is up over 147% just in the last year. But help me understand the connection here. Why is Microsoft crashing while silver is flying? Is this just fear? Are people just panic selling tech to buy gold bars?
Well, it's a bit more calculated than just panic. Think of it more like a great rotation. Investors are looking at the tech sector, especially that whole AI boom, and they're starting to ask some really hard questions about profitability. A giant like Microsoft dropping 12% on, soft Azure momentum and higher capital costs. That tells you the market is tired of promises. They want safety. So capital is fleeing those paper assets, those growth stocks, and it's just flooding into hard assets.
Okay, but let's unpack the why on the macro side. Because usually when the Federal Reserve does something, that's the main driver. And we did get a Fed announcement today. They held interest rates steady at 3.5 to 3.75%.
Correct. No rate cut today.
So this is where I get confused, and I'm guessing a lot of people listening are scratching their heads too. Econ 101 says that high interest rates, or at least not cutting rates, that's bad for gold, right? Gold doesn't pay you anything. If I can get almost 4% in a risk-free money market account, why would I buy a rock? So why are metals flying if the Fed didn't cut? The whole algorithm seems broken.
And that is the fascinating disconnect we're seeing. You're absolutely right. Traditionally, higher rates hurt gold. But the market is forward-looking. It doesn't care about today. It cares about 6 months from now. The Fed held rates, yes, but the statement they released acknowledged that the labor market is stabilizing, yet inflation is still sticky. It's sitting around that 2.7 to 2.9% range.
Stickier than they'd like.
Much stickier. But here's the real kicker. 2 Fed officials actually voted for an immediate cut. That signals division. The market smells blood in the water. They believe the Fed is completely cornered. They have to cut eventually to save the economy, even if inflation isn't perfectly under control. So investors are pricing in those future cuts now.
So it's a big game of chicken, and the market thinks the Fed is going to blink first.
Precisely. And you have to look at the currency component, too. The U.S. dollar index, the DXY, has dropped to 4-year lows. It's hovering around 96. Gold is priced in dollars, so when the dollar gets cheaper, gold gets more expensive just mathematically. But it's more than just math. It's about confidence.
Yeah. Which brings us to the political side of this. We saw President Trump's comments recently, directly criticizing the Fed's independence and sort of downplaying the dollar's drop.
That is a huge, huge factor. When the head of the executive branch says he's okay with a weaker currency, or worse, that he actively wants it to boost exports, and at the same time attacks the central bank, well, foreign investors get very nervous. They start asking if the dollar is really a safe place to park their money.
Right. I kept seeing this term in the notes, the debasement trade. Can you break that down in plain English for us? It sounds like something out of a pirate movie.
It does, doesn't it?
Yeah.
But it's actually pretty scary. The debasement trade is just the market losing faith in the government's checkbook. We're running a $2 trillion annual deficit. There's just no fiscal discipline. So investors look at that mountain of debt and they say, the only way they can pay this off is by printing more money, which makes the money I'm holding worth less. So they trade their paper money for something the government can't print. They can print dollars. They can't print gold.
That makes perfect sense. It's a vote of no confidence. But it's not just about economics, is it? I mean, weak money usually signals weak power. And I want to pivot to the scary stuff now, because looking at the geopolitical section of our sources, it looks like a Tom Clancy novel out there.
It really does. And you just cannot separate the price of gold from the fear index right now. And frankly, that weakness in the dollar we just talked about, it emboldens our rivals. It signals a lack of control.
Let's start with Iran. This isn't just tough talk anymore.
No, the situation in the Strait of Hormuz has escalated. Well, significantly. We have reports that the U.S. is warning of military action, and they've positioned a large naval force that's ready to act with speed and violence. Those are direct quotes from the Pentagon.
And Iran isn't backing down. They're doing live fire drills, vowing to respond like never before. And on top of that, the EU just designated the IRGC as a terrorist organization.
Which really complicates any diplomatic off-ramps. When you have live fire drills in the most important oil choke point in the world, risk premiums just explode. Gold is the ultimate geopolitical hedge. When missiles might fly, you don't want to be holding risky tech stocks. You want gold bars in a vault. It's the fear trade.
And then there's this bizarre situation with Greenland. I honestly had to double-check the date on this report. The U.S. is putting tariffs on European countries, Denmark, Sweden, the U.K., France, starting February 1st.
February 1st, 2026, just days away.
And let me get this straight. We're taxing French wine and Swedish furniture because we want to buy Greenland.
That appears to be the leverage point, yes. It sounds surreal, I know, almost like satire, but the market impact is very real. This creates massive, massive uncertainty in global trade. If you're a European manufacturer, suddenly you're looking at a 10% tariff wall, maybe going up to 25%. That just blows up supply chains.
It just seems so chaotic. Sell me your island or I'll tax your cheese.
It breaks all the norms of international diplomacy. And markets hate unpredictability. If the U.S. is willing to do this to its allies, what else is on the table? Where does capital go for safety when the entire Atlantic alliance is shaking? Again, it goes to gold and silver.
It seems like every single headline is just pushing people toward metals. We've also got Operation Absolute Resolve, the naval blockade of Venezuela.
Right, which has been going on since late 2025. It's disrupting oil markets, which then adds to the inflationary pressure we talked about earlier. High energy prices feed inflation, which makes gold more attractive. It's all connected, a whole web of instability.
So you've got the Fed corner, the dollar crashing, war drums in the Middle East, trade wars in Europe over an island, and blockades in South America.
It is the definition of a perfect storm.
Before we dive into why silver might be the real star of this show, because honestly, that industrial story is fascinating, I just want to take a quick second to talk to you, our listener.
An important pause.
If you like what you're hearing today, we'd love it if you'd subscribe to the channel, leave a like, and maybe comment on what topics you'd like us to cover in the future. In the description of this deep dive, you'll find a PayPal link if you want to support this project. Your contribution really helps us keep creating content like this. We don't ask for more than the price of a coffee. Thanks for your support.
We really do appreciate it.
Okay, let's talk about silver. Because gold gets the headlines, 5,500 is a big round number, but silver trading over $110. That feels structurally different. It's not just gold's little brother anymore, is it?
No, it hasn't been just a monetary metal for a long time. But the market is finally waking up to the reality of the supply chain. We are currently in the 5th consecutive year of a structural supply deficit for silver.
Meaning we're using way more than we're digging up out of the ground.
Significantly more. Demand is just outstripping supply, and we're draining all the above-ground stockpiles. The inventories at the major hubs, London, New York, they're at critically low levels.
But if the price is $110, surely the miners are rushing to get more, right? Why isn't the market just correcting itself?
That's the inelastic supply problem. It's a little technical, but think of it this way. Silver is usually the toy in the Happy Meal.
Hmm.
You buy the Happy Meal, which is a copper or a zinc mine, to get the burger. The silver is just that extra little toy that comes with it. You don't buy 10 more Happy Meals just to get more toys if nobody wants to eat all those extra burgers.
That is a fantastic analogy. So because silver is mostly a byproduct, they can't just ramp up production easily.
Exactly. Even if the price of the toy goes through the roof, you can't justify mining all the other stuff just to get it. That's why supply is stuck. It takes years to bring a dedicated silver mine online.
Yeah.
Meanwhile, demand is it's vertical.
So what's eating all the silver?
The green energy transition. You literally cannot have a green future without silver. It's the most conductive metal on the planet. Solar panels, or photovoltaic cells, they are consuming massive amounts. Solar demand hit records in 2024 and 2025, and it's still accelerating.
And it's not just solar, is it? I saw mentions of EVs and AI in the notes.
Exactly. Electric vehicles use way more silver than gas-powered cars for all the contacts and electronics. And now, AI data centers. These huge computing hubs need extreme efficiency in power transmission. Silver is absolutely essential for that hardware.
So if gold is the defense against all the scary geopolitical stuff, silver is the offense for the tech future.
That's a perfect way to put it. Gold protects your wealth from the government. Silver lets you participate in the industrial future. But here's where it gets really interesting to me. It's not just companies buying it for solar panels. I saw a note in the Saxo Bank report about Russia.
Yes. This caught my eye too. The Russian finance ministry is allocating something like $535 million just to accumulate silver reserves.
This is a major shift. Central banks usually buy gold. For a central bank to step into the silver market, which is much smaller and way more volatile than gold, it's like a whale jumping into a small pond. It creates these massive waves.
But why silver? Is it just to mess with the West?
I think that's part of it. It signals a diversification away from the dollar, joining countries like Poland and China who are stacking metals. But it also squeezes the West where it hurts, in our industry. If Russia locks up a big chunk of the silver supply, that makes it harder for us to build those solar panels and missiles we need. It turns a commodity into a strategic weapon.
So you have industrial companies desperate for silver, competing with investors fleeing the dollar, competing with the Russian central bank. No wonder it's at 112.
And remember what they say, silver is often called gold on steroids. When it moves fast. We are seeing a squeeze in the truest sense of the word.
Okay, so let's bring this all down to earth for a minute. I'm thinking about the person listening to this on their commute. They've got a 401k, maybe some stocks. What does this new normal mean for them? If the debasement trait is real, does a traditional portfolio even work anymore?
That is the hard question, isn't it? The traditional 60-40 portfolio, 60% stocks, 40% bonds, it relied on the idea that when stocks go down, bonds go up. But if we have persistent inflation and a debt crisis, stocks and bonds might just go down together. That's why we're seeing this rotation into real assets.
It feels like we're establishing a new normal where you actually need to own things, not just paper promises.
I think that's exactly the right way to frame it. The world is moving to a multipolar system. You have the U.S. bloc, the BRICS bloc, trade wars, fractured supply chains. In that kind of world, physical assets, things you can hold, things you need for industry, they matter a lot more than paper promises or derivatives.
So looking forward, where do we go from here? I mean, 5,500 for gold and 112 for silver feels like a ceiling, but the sources are suggesting otherwise.
The forecasts are being revised up almost daily. Deutsche Bank is now predicting $6,000 an ounce for gold in 2026. And you have some of the more extreme but historically accurate macro guys like Tom Bradshaw talking about $9,000 by 2028.
$9,000 gold, that is. That's hard to wrap my head around. That would mean the dollar buys half of what it buys today.
It would imply a very significant devaluation of the currency, yes.
Yeah.
As for silver, targets of $100 used to be the moonshot. Now $100 is basically the floor. Some analysts are looking at $135 or even higher if this shortage continues through the year.
It really makes you think. We all grew up in a world where the dollar was king and bonds were the safe haven. But if the dollar keeps weakening and tariffs block global trade and central banks are buying physical metal, are we looking at a future where gold and silver are the only universal currency left?
That is the multi-trillion-dollar question. And looking at the charts today, the market's answer might just be yes.
Wow, a lot to digest. And with that, I think we reached the end of today's deep dive.
It's been a fascinating one, a big day.
We hope you liked it, learned something new, and will join us for the next one. Thank you very much, and we'll meet again very soon.
Goodbye, everyone.
And remember, the PayPal link is in the description if you want to help us out. Thanks once again. Cheers.
Oh, and just a quick personal note before we fully sign off. Hello, and a very good Thursday to everyone. We are actually taking the opportunity to go on vacation for a few days right after this recording.
That's right. We're heading off to cold New York.
So it's not that we won't do reports, maybe not every single day, but we will surely see things that tempt us. We'll definitely report on any market things we see during the 10 days we're in New York. I mean, that city will surely give us thousands of things to tell you about.
We might just end up reporting from Wall Street itself. Who knows?
Exactly. So if we're a little quieter than usual next week, that is why. Stay tuned. We'll see you from New York.